As of 12:02 p.m. Eastern Time, with the market live and trading, shares of Rezolve AI PLC, ticker RZLV, are moving significantly. The stock is currently trading at $4.16, which is a gain of 3.23% or 13 cents on the session. This intraday strength is notable, but it is just a small snapshot of one of the most volatile and debated stocks in the small-cap AI sector. The immediate expectation for many watching this name is that it's just another cash-burning AI company with a flashy press release. The reality, however, is that RZLV is attempting to build something far more foundational, and the market cannot decide if it's a brilliant strategic pivot or a house of cards. What most of the surface-level discussion misses is the company's recent aggressive pivot away from just being a software provider to becoming an integrated data and payments backbone. The acquisitions of SmartPay and Subsquid last month were not minor tuck-ins. They were declarations of intent to build the infrastructure for what they call agentic commerce, and perhaps more critically, to power a new digital asset payment system in a major partnership with Tether. For months, the general belief surrounding RZLV has been one of extreme confusion, and for good reason. If you monitor retail forums or social media, you see a stock that is whipsawed daily between narratives of massive opportunity and impending disaster. On one hand, you have chatter about its partnerships with giants like Microsoft and Google. On the other hand, the feed is flooded with alerts about multiple law firms, Pomerantz, Rosen, the Shaw law firm, all announcing investigations into the company, which creates an immediate sense of panic and distrust. This is the central tension of RZLV. The expectation is that where there is this much legal smoke, there must be fire, and that the stock is too dangerous to touch. The reality is that while these investigations create a massive overhang and serious headline risk, major financial institutions and analysts are looking at a completely different set of data. They see a company that recently smashed earnings estimates, prompting analysts to significantly raise their price targets, with a new consensus sitting near $10.79. This isn't a minor disagreement. It's a fundamental disconnect between the legal noise and the forward-looking financial models. The stock's recent movement reflects this battle perfectly. This is a name that has traded as high as $8.45 and as low as $1.07 within the last year. The past month alone has seen a devastating drop of over 30%, which is what triggered the ambulance-chasing law firms. That drop was, according to many retail investors, kicked off by a short report that was later debunked when the company posted strong earnings. This kind of volatility is a magnet for high-frequency traders and a nightmare for long-term investors. Volume has been sporadic, exploding on news days and drying up in between, suggesting that the institutional money is still watching from the sidelines, waiting for a clear winner to emerge in this tug-of-war. We are seeing institutional filings, however, that complicate the bearish narrative. Firms like Citadel have disclosed a passive stake, and names like BlackRock, Vanguard, and Geode Capital Management are all listed as significant holders. This isn't the ownership profile of a typical company on the verge of collapse. It suggests that the smart money believes there is a tangible, valuable asset here, even if the public-facing narrative is a complete mess. This brings us to the critical topic of short selling activity, which is an area of intense focus for RZLV holders. There is a persistent belief that the stock is the target of a coordinated short attack. When we look at the actual data, the story is more nuanced. It is absolutely crucial for investors to look at the right data. Many are confusing RZLV with an entirely different company, Zone, which has astronomical borrow fee rates in the triple digits, That is not what is happening here. According to Fintel, the most recent short borrow fee rate for RZLV is approximately 8.7%. Now, that is not low. It is significantly elevated compared to an average stock, indicating that it costs a premium to borrow shares to sell short. But it is not the 200% rate that would signal a massive imminent squeeze. The short interest itself, as a percentage of the float, is high, but not at a critical level. What this data tells us is that there is a genuine, funded bearish contingent betting against the stock, but they are not trapped. For retail investors, the actionable step here is to learn how to interpret this data correctly. You can access short interest data from platforms like Fintel or Ortex. When you see a borrow fee rate, an 8% rate on RZLV means it costs shorters 8% annually to hold their position. It's a sign of pressure, not panic. A 200% rate on a different stock means it costs them 200% annually, and they are likely desperate to close their positions. Do not confuse the two. The fake short report narrative that circulated on Reddit and X is a perfect example of the information warfare surrounding this stock. The bearish thesis isn't just about the cash burn. It's a deep-seated distrust of the CEO, Dan Wagner, and the company's complex structure. What's your take on these law firm investigations that paper the news feeds? Are they a genuine red flag pointing to deep-seated issues, or are they just opportunistic noise trying to capitalize on the stock's volatility? To understand the bull case, you have to look past the stock chart and understand what Rezolve AI actually does. The company is operating on two fronts. The first is its internal-facing AI service desk, a platform to help employees with IT and HR issues, competing in the enterprise software space. The second, and far more significant, is its agentic commerce platform. This is the brain suite of AI solutions designed to power conversational commerce. This is what secured the partnerships with Microsoft, leveraging its Azure AI, and Google. But the most disruptive piece of this puzzle is the recent partnership with Tether. Rezolve is integrating its technology to enable fee-free crypto payments, specifically using USDT for merchants. This, combined with the acquisitions of SmartPay for digital asset payment infrastructure and Subsquid for decentralized data, shows a clear strategy. Rezolve doesn't just want to be an app. It wants to be the toll booth, the data processor, and the payment rail for a new wave of AI-driven commerce. This strategy is exactly what has analysts so optimistic, even as the stock price has fallen. The consensus strong buy rating is built on projections of massive revenue growth, with some models forecasting a jump to $165 million in 2026, and, perhaps more critically, a path to potential operating profitability by the first half of that year. The company just appointed a former Microsoft executive to lead its U.S. expansion, a move seen as a major step towards commercializing these high-level partnerships. The bull case is clear. If Rezolve can execute on even a fraction of this vision, the stock is profoundly undervalued at $4.16. The average analyst target of $10.79 implies a potential upside of over 150%, with high-end targets reaching towards $15. The bear case, however, is just as compelling and cannot be ignored. The company is burning cash at an alarming rate, with annual reports showing a net income loss of over $170 million. This is a race against time. Can they reach profitability before they need to raise more capital and dilute shareholders further? Furthermore, the leadership changes, including a recent shuffle where the head of finance moved roles, have spooked investors. There was a feeling of instability. The bear case hinges on execution risk. It's one thing to announce a partnership with Microsoft. It's another to convert that into millions of dollars of recurring revenue. Bears also point to the fact that the company itself has guided for near-term gross margin contraction as it builds out its new professional services division. And underlying all of this is the persistent distrust of the CEO, which makes it very difficult for many retail investors to hold the stock with confidence, regardless of what the analysts say. Comment below with your thoughts on the Tether partnership. Is integrating fee-free crypto payments the key to adoption for their commerce platform, or is it just adding another layer of regulatory and operational risk to an already complex story? So we are left with a stark contrast. The expectation, driven by legal headlines and social media panic, is that RZLV is a speculative, failing, and perhaps dodgy AI stock. The reality is that it's a deeply complex turnaround play, backed by major institutions and bullish analysts, that is making aggressive and foundational acquisitions in